I don't think Alibaba is as entrenched as something like Apple and Alphabet. I think the internet is going to be a very competitive place, even if you're a big internet.
Charlie Munger. Everyone is wrong about Alibaba, and here's why. The Alibaba Group was once the star of Wall Street, but ever since Jack Ma's infamous speech at the 2020 Bund Finance Summit and the COVID-19 pandemic, the Baba stock has tumbled by more than 50% over the course of 2021. Yet there is one investment titan who hasn't lost faith in the company. Despite a dismal 2021 and continued concerns not just about regulatory risks, but also the overall stability of the Chinese economy, Charlie Munger, Berkshire Hathaway's vice chairman, has steadily doubled down on the Chinese tech stock. Welcome to Wall Street Winners. Today we'll discuss why Charlie Munger believes that everyone is wrong about the Alibaba stock. Over the last few years, investing in China hasn't always been sunshine and rainbows. The real estate crisis, anti-for-profit education, reduction in gaming, CCP regulations, and risks associated with delisting have deterred investors from investing in any Chinese-based companies. Shares of Alibaba too went through a nearly 50% drop in pricing in FY 2021, as bad headlines against the company continue to pile up. The Chinese Communist Party fined tech monopolies for their apparent abuse of market positions. This forced Alibaba to cut its revenue forecast for FY 2022 due to the post-pandemic market slowdown. Additionally, there were fears over an ADR delisting, and Alibaba's variable interest entity structure impacted the company's stock pricing in an extremely negative way. Despite these risks, the Munger-led Daily Journal Corp, or DJCO, nearly doubled its stake in Alibaba in the third quarter of 2021, moving its stake considerably north of 300,000 shares of ADRs, or American Depository Receipts. The investment portfolio of the Daily Journal began buying Alibaba shares in the second half of 2021. In the year's fourth quarter, its position in Alibaba effectively doubled, making Baba DJCO's third largest holding, following Wells Fargo and Bank of America. Its reported price in January 2022 was said to be $121.16. This big bet over the course of the quarter brings Munger's total stake in the stock to over $70 million, which is not a small sum, even for the 98-year-old investment tycoon. As Alibaba's stock plummeted over 40% in 2020 and has hardly bounced back from a crisis in early October, which wiped out 4 years of gains, investors have just one question for Munger. Is he moving in at the right moment, or is it a big mistake? Munger, on the other hand, is quite optimistic about his investment. He stated that whilst only the future knows who is right, he believes that China is a big, modern nation with a skilled population that became well-versed with modernity in the last 3 decades. He said the DJCO had invested money in China since they believed they could get more value from the investment, in terms of strength of the enterprise and price of the security, than they would have gotten in the United States. Munger's bet on Alibaba is particularly noteworthy because in the past, he has made several controversial comments praising China for how the country handled criticism from tech moguls like Jack Ma, Alibaba's co-founder and former executive chairman. He had also commented in the past that in his opinion, China was investable and that he had never considered investing in China either short-term or long-term. He cited he didn't trust the data from China, nor did he trust the relationship between the US and China. He added that investments in the country could be confiscated at any time, making it a risky venture. Yet, Munger increased his investment in the Chinese e-commerce powerhouse. As an experienced value investor, Munger, as stated by him in an interview, understands the large impact emotions had on Alibaba's pricing. Because of the reasons mentioned above and the multiple problems stacking up against the company in 2021, the market no longer rationally looked at Alibaba's prospects for sustained e-commerce growth, especially in its core markets. As a result, its platform value was discounted quite steeply. Whilst it's true that negative factors including the Russia-Ukraine conflict and resultant trade and financial sanctions continue to affect Alibaba's share price to this day, the firm still has the largest e-commerce platform in the world, with an estimated 1.2 billion active accounts, all of which contribute to the company's intrinsic value. Of course, Alibaba's top-line growth is moderating, but its e-commerce platform will draw a considerable number of new shoppers into its ecosystem in the near future. The materializing growth is especially evident in the company's retail marketplace outside of China. For example, Lazada in Southeast Asia and Trendyol in Turkey are witnessing strong customer acquisition. It is estimated that Alibaba is likely to add around 50 million new customer accounts to its ecosystem every quarter, leading to a total of 1.5 billion active users on its platform by the end of 2022. It's also important to note that approximately 23% of Alibaba's customer accounts are on platforms that service customers outside of China. Apart from Lazada and Trendyol, these include Daraz and AliExpress. According to Alibaba's official stats, Lazada, which is headquartered in Singapore and active in key markets like the Philippines, Malaysia, Indonesia, Vietnam, and Thailand, has already risen like a phoenix to become the 7th largest e-commerce platform in the world in terms of its monthly active users. The brand undeniably has the potential to grow its users and subsequently rise to the top in e-commerce company rankings. One of the biggest indicators in favor of this outcome is that Lazada's e-commerce penetration rate in Southeast Asia is still relatively low, at 11%. Its market potential is far from being exhausted. During the pandemic, consumers shifted their sales online, because of which Lazada saw a strong increase in monthly active users and accounts. By September 2021, the company had 159 million monthly active users, which displayed a factor increase of 1.7 times over an 18-month period. If we consider things from a bullish perspective, Alibaba is a leading player in Chinese e-commerce, payments, and fintech, and the cloud. Its entrenched positions in these three high-growth sectors confirms why Munger is so optimistic in terms of the long-term growth prospects of China and its rising middle class. Munger also swooped in at the right moment when the IPO of Ant Financial, Alibaba's subsidiary, was stopped by regulators. He bought shares when Alibaba's PE ratio fell to the high 20s. However, at that time, Alibaba also had about $135 billion in net cash and other investments in other companies, so its core business was much cheaper. Similarly, Alibaba has several promising but loss-making subsidiaries, including its cloud computing platform AliCloud, which has a significant positive value but still contributes negatively to current earnings. In summer 2021, Alibaba's valuation fell all the way to just 17.3 times trailing earnings. This made its shares extremely cheap, especially if you consider the company's massive cash holdings and investments in other loss-making segments. Even with all the negativity surrounding Alibaba's stock currently, analysts predict a positive future growth, albeit more dialed back. According to 2023 estimates, the company trades at only 13.3 times earnings. There are also other factors that back this bullish perspective. In mid-January 2022, the US dollar has fallen 1.8% against the Chinese renminbi. Interest rates in China were about 4%, indicating that if its economy were to significantly slow down, it could lower rates and print more to support the economy. On the other hand, the Fed had already used all its ammunition. Russia's invasion of Ukraine has plummeted the global economy in jeopardy. The US and its EU allies have issued several sanctions against Russia to economically isolate the world's third largest oil producer. Apart from financial sanctions, which banned 7 Russian banks from the SWIFT money exchange platform, the US also imposed a ban on Russian energy imports, which sent oil prices around the world soaring. If things continue to escalate, China might as well have an opportunity to boost its economy. The market research firm IDC, or International Data Corporation, also predicted that the cloud industry in China was expected to grow by a compound annual growth rate of over 30% till 2025, when it could reach an $87 billion valuation. The cloud market in the country is driven by infrastructure, whereas in the US, it is more software focused. As of the third quarter of 2021, Alibaba's cloud system, AliCloud, has a 38.3% market share in mainland China. The third indicator for a bullish outcome for Alibaba comes from the sales reports on Singles Day, a major shopping holiday in the country on November the 11th. The company reported a gross merchandise volume of $83 billion in 2021. an increase of 15% from 2021, hence proving that the Chinese e-commerce ecosystem has resilience. Another question to ponder upon is that while Alibaba's main focus is China, the antitrust regulatory landscape in the country is still in flux, making it hard to predict how big techs like Alibaba will grow domestically. In such a scenario, overseas expansion beyond China is a bigger priority, aligning with the government's vision of growing the country's overall influence. Whilst Alibaba has a big presence in Europe and Latin America, could it also begin services in Africa? Do you think Charlie Munger made the right decision? What are your takes on the Alibaba stock? Comment below. If you liked our video, subscribe to our channel, hit the like button and turn on the notification bell. Share the video as far as possible because the more you know, the more you grow. And goodbye.